Hello, everyone, and welcome back to the Everyday English Bite. Whether we are dreaming of buying a new car, saving for a house, or just trying to manage our monthly budget, we all have to deal with banks. They are the heart of our financial system. But banking English can be confusing with all its specific terms. Today, we are going to simplify everything. We will explore the most common ways to save your money, the different types of loans you can take, and how banks actually function. By the end of this episode, you will feel much more confident talking about your finances in English. As always, let's start by mastering some essential vocabulary. Here are 3 foundational words for any banking conversation. First is interest rate. An interest rate is the percentage of a sum of money charged by a bank for a loan or paid by a bank to a saver. It's basically the price of money. Example 1, the central bank decided to raise the interest rate to fight inflation. Example 2, I'm looking for a savings account that offers a high interest rate. Example 3, before signing the contract, always check if the interest rate is fixed or variable. Next, we have principal. In finance, the principal refers to the original amount of money you either invested or borrowed before any interest is added. Example 1, if you pay off the principal quickly, you will save a lot of money on interest. Example 2, my monthly payment covers both the interest and a small portion of the principal. Example 3, the bank guarantees that your initial principal is safe in this savings plan. Last is maturity. Maturity is the specific date or time at which a financial agreement, like a deposit or a loan, becomes due and must be paid in full. Example 1, you will receive a penalty if you withdraw the money before the date of maturity. Example 2, my 3-year time deposit is finally reaching maturity next month. Example 3, at maturity, you can choose to either take your cash or reinvest it into a new plan. Excellent! Now that we have the basics, let's get into the details of savings and loans. The article, the money cycle. Section 1, putting money in, common savings products. Banks exist to move money from people who have it to people who need it. When you put your money into a bank, you're essentially lending your money to the bank so they can use it. In return, they pay you interest. There are 3 main types of savings products you should know about. First is the savings account, or demand deposit. This is the most flexible type of account. You can put money in and take it out whenever you want using an ATM or your smartphone. Because it is so flexible, the interest rate is usually very low. It's best for your daily spending money. Second is the time deposit, often called a certificate of deposit or CD in some countries. This is for a lump sum of money. For example, if you have 10 million won that you don't need right now, you give it to the bank for a fixed period, like 1 year or 3 years. Because you promise not to touch it until maturity, the bank gives you a higher interest rate than a regular savings account. Third is the installment savings. This is a great way to build wealth slowly. Instead of putting in one large lump sum, you commit to saving a specific amount of money every month for a certain period. It's like a subscription for your future self. Now let's talk about the other side of the bank, loans. A loan is when the bank gives you money and you promise to pay it back over time, plus interest. There are 2 main ways banks think about loans: collateral and credit. Vocabulary check. Collateral. Collateral is something valuable, like a house or a car, that you give to the bank as a guarantee. If you cannot pay back the loan, the bank takes the collateral. Because of this guarantee, a mortgage, which is a loan for buying a house, usually has a lower interest rate. The house itself is the collateral. On the other hand, we have credit loans or personal loans. These are loans where you don't provide collateral. The bank gives you money based solely on your credit score, which is a record of how well you have managed money in the past. Because there's no collateral, these loans are riskier for the bank, so the interest rates are usually higher. Another common loan is a line of credit. The bank gives you a limit, say $5,000, and you can borrow and pay it back as much as you want within that limit. You only pay interest on the exact amount you are currently using. You might wonder, how does a bank pay for its huge buildings and staff? They do this through something called the interest rate spread. Think of it this way. The bank pays you a 2% interest rate for your savings. Then they take that same money and lend it to someone else for a 5% interest rate. The 3% difference is the spread. This spread is the bank's main source of profit. It covers their costs and their risks. This is why when global interest rates go up, the rates for your loans usually go up faster than the rates for your savings. Banks are always trying to manage this balance to stay profitable while keeping their customers happy. Today's English idioms. We have covered a lot of ground today. To wrap things up, let's look at 3 common English idioms related to money and balancing. I'll explain their meanings and the typical contexts in which they are used. First, a rainy day fund. This refers to money that you save specifically for an unexpected emergency or a difficult time in the future, the rainy day. In daily life, we use this when talking about the importance of having installment savings or a separate savings account that you don't touch unless it's absolutely necessary. It's about financial security. Example 1. Even if you want to buy a new car, you should always keep some money in your rainy day fund. Example 2, my medical bills were huge last month, but luckily I had a rainy day fund to cover them. Example 3, experts suggest that a rainy day fund should cover at least 3 to 6 months of your living expenses. Next, we have the bottom line. This term comes from the very last line of a financial statement, which shows the final profit or loss. In a business context, it means the net profit. In general conversation, it is used to describe the most important point or the final result of a long discussion. When choosing a loan, the bottom line is usually how much total interest you will have to pay. Example 1, we discussed many marketing ideas, but the bottom line is that we need to increase our sales by 10%. Example 2, the bottom line of this new bank policy is that customers will have to pay more fees for wire transfers. Example 3, I don't care about the fancy features of the credit card. Tell me the bottom line. What is the annual fee? Last, balance the books. Literally, this means to make sure that the amount of money coming in, income, is equal to or greater than the money going out, expenses, in an accounting book. We use this idiom when talking about managing a household budget, a business, or even a country's economy. It's about being responsible and making sure you aren't spending more than you have. Example 1, it's getting harder to balance the books with the rising cost of groceries and electricity. Example 2, the government is struggling to balance the books because of the unexpected increase in defense spending. Example 3, if you want to save for a house, you need to learn how to balance the books every month. And that is our bite for today. You now know the difference between time deposits and installment savings, how mortgages work, and what a rainy day fund is. Take a look at your own bank accounts this week and try to describe them using today's words. Thank you for listening to the Everyday English Bite, and I will see you in the next episode for another bite of knowledge. Stay smart with your money.